Hi, Andrew Cooper here, Advice for Living Financial Planning. This is our March market update. I've done also two other videos today, one on the report of the Royal Commission into aged care and another one on major changes to income protection. Now there was a fair bit to say on both of those topics, and so I did them as separate videos. They don't relate to everybody, so for some of you who do have an interest or something that's important to you, then you might want to look at those. But for those of you that it doesn't relate to, you don't need to sit through me talking about them. Financial markets. At the moment, they all seem to be providing quite complex and in some ways confusing messages. Now, as we all know, residential real estate seems to be going nuts, unless of course you've got an inner city apartment, in which case not so much. Commercial property, however, has had some sort of a recovery, but as I've said before, and as I've spoken with a number of you in reviews, I'm concerned about the medium-term future for commercial property. My understanding is that there are large amounts of empty office space, particularly in CBD areas, but also in suburban centres. Also, there's increasing numbers of vacant retail spaces available, and with the ending of JobKeeper in just a couple of weeks, I suspect that this situation could get worse. As a result, we've been moving many of you out of property funds and into either global share funds or infrastructure, depending upon the makeup of your portfolio. We have left some people with some property exposure, but that's because of the nature of those particular funds and what they're invested in, or alternately because of the size of the exposure. And we'll continue to do that as we meet you for reviews. Fixed interest, which is generally a fairly dull area of financial markets, could provide some concern and some volatility this year, in particular in the US. Now, like Australia, the United States has very low interest rates, but with the change of federal government, there has been a loosening of government purse strings, an indication there'll be a lot more money moving into areas, particularly, say, infrastructure, also social services, and as well as that, there's talk about an increase in national wage rates. This is already beginning to fuel some ideas about inflation. The Federal Reserve, which is the US Reserve Bank, has indicated that they will contain inflationary issues, but there is now concern that despite what they've said, they may not be able to do that. A rise in inflation would affect long-term government bonds, so 10-year government bonds which are locked in at very low rates, and also would most likely have an impact on the share market. Now, in terms of share markets in the US in particular, but also other share markets around the world, and Australia is included in this, they've really broken into two parts. There are the current darlings of the share market, which are the tech stocks, and they have their share prices have raced well ahead of any inherent value in the companies. Now, many of these companies have never made a profit, and there are indications that some of them may never do that, but that hasn't stopped their share prices from rocketing well ahead of normal market fundamentals. There are a number of people harking back to the late 1990s and early 2000s when we had the what they call the tech wreck, where a lot of these internet companies which really did nothing. You know, if you put www in front of the name, all of a sudden it was worth a fortune. So these companies, there's some indications that we might be seeing a bit more of that, which would be worrying. Now, the second part of the share market are those companies that have cash on their balance sheets. They actually make things or provide a service, and they pay dividends. Now, these less favoured or value stocks have not seen the dramatic increase in share prices that their technology cousins have. So with the slowdown in government subsidies and the likely increase in inflation, indications are that we could see a correction, particularly with those technology stocks. Now, my hope is that correction will be relatively moderate or at least steady, and that to compensate, the value stocks will begin to increase their share prices. This combination would see the market return to more normal valuations, but without a major shock in share prices. Now, we've already begun to see a reduction in some of these very expensive shares. CSL, for example, has come down from just shy of $300 a share down to about $250 a share, even though we know they're going to be manufacturing the AstraZeneca vaccine. Likewise, a number of tech stocks in the US have begun to decline, and as a result, I'm being quite cautious with share investments at the moment. And I know there are a number of you sitting with cash waiting to invest in the share market, and I've said I would like to wait and see what happens when the government subsidies stop before jumping into the market at what I think are still quite elevated prices. I should say that I'm not expecting or predicting a collapse in share prices, but I can't help but think that some of the more dramatically overpriced companies could see their share price come down over the course of this year. How that happens is still to be seen. Now, on the positive side, all indications are that in the Australian share market at least, dividends should begin returning to their normal levels. So we should expect that this could go some way to propping up the share prices. So for those of you who are already invested, I'm not suggesting that we should pull out, but for those with cash to invest, as I've said earlier, I would just like to wait a little longer until we get a better picture of what's going to happen. Now, as always, if you've got any concerns, any questions, please feel free to give us a call, and we'll be happy to have a chat or arrange a time to catch up. Thanks so much. Bye.